So this is the retained earnings statement. The retained earnings statement that you know and love so far is right up there. We start off with the beginning retained earnings. We add the net income, we deduct dividends, and we end up with our ending retained earnings. That's what we know so far. What we get into in AC 102, a bit more detail. We'll learn about the restrictions on retained earnings, how to handle prior period adjustments, and we'll have both cash dividends and stock dividends that will be reported on the retained earnings statement. So let's start with the retained earnings restrictions, because we ordinarily don't make any journal entries for them, although some companies will, but we don't have to, okay, at this point. So generally, when stockholders and others look at retained earnings, they think, oh, those are available to pay us some dividends. Oh, goody. But management may have other plans for the earnings that they have retained. They may have a big bond issue that's coming due that they're going to have to pay off. They might want to be expanding their plant facilities. And so they'd prefer not to be signaling to their stockholders that they have a overabundance of retained earnings that's available for distribution as dividends. So usually restrictions are reported in the notes to the financial statements, and so you would have on your retained earnings statement, you would just say see note 1, or whichever note it was about the restrictions on it. The restrictions can be legal. In some states, there may be some restrictions on the amount that a company has to keep as retained earnings. There may be contractual restrictions. When a bank gives a loan to a corporation, they may require a certain retained earnings balance be maintained just for their comfort zone. And then voluntary, that's where the board of directors has other plans for the company's retained earnings. So they were disclosed in the notes, and some companies will do a journal entry. Okay, so as far as prior period adjustments, these are called prior period adjustments, but what they are really errors that have been made in financial statements that have already been issued. So it's this year we noticed that depreciation expense was materially off. It was maybe overstated or understated last year. The financial statements are done, the books are closed, the financials have gone out. And so what we end up doing is we use the word adjustment, not error, but we're going to adjust the beginning retained earnings when there is a prior period adjustment. And then we describe what the error is and the impact on net income. And then we have our beginning balance as adjusted. So when there is a prior period adjustment, what happens is we would have, at the beginning, we would have retained earnings January 1 as stated or as reported. And that's important because that signals that yes, there is a prior period adjustment coming. And I think as reported might be better. I think that's what I have in my notes. I think you'll see companies do it both ways. Okay, so then we go prior period adjustment. And we would describe what the adjustment was. We say that we say the impact on net income. We could say net income was either over or understated, and then we would say what sort of error it was, depreciation or bad debt expense or wherever it was we happened to goof it up. Okay, so if net income last year was overstated, that means that we have to adjust down. So we might make a $500 adjustment down, and then we would say retained earnings and it's still the beginning balance, January 1, but as adjusted. Okay, and so we would start off with our retained earnings as adjusted. Then we would go on and do our usual add the net income or deduct a net loss, deduct our cash dividends, deduct our stock dividends, and come down to the ending retained earnings. I do give an example on this of the Piper Company, and let's just work with that. It says the depreciation expense, they discovered that depreciation expense was overstated by $500. So the error that they made was the expense, depreciation expense last year was too high by $500. Now if the expense last year was too high, overstated, that means that net income last year was too low, okay? So, and yeah, sometimes it's good to just say if depreciation expense was too high, then net income was too low, and when we make the adjustment, we have to adjust up, okay? So here we would say prior period adjustment, net income was understated due, and then to a depreciation error. Okay, and so if net income was understated, we're making the adjustment up. And in the example, I have 10,000 here. Sorry about that. There we go, 10,000. So our beginning retained earnings as adjusted is now 10,500. And then we go in and we add our net income, and you can sort of see how, well, we'll just do this. We'll add the net income. And the net income given was $4,000. Okay, and then we're going to go less dividends, and we have both cash dividends. And now that you know how to do stock dividends, you have to remember that they also are deducted. They reduce retained earnings, and so they are also shown as a deduction on the retained earnings statement. I think I had 1,000 here and 800. Okay, so we're taking off 1,800 in dividends, and so we end up with our retained earnings at 1231. Of 12,700. Okay, so whenever there is a prior period adjustment, you definitely need the as reported, you definitely need the as adjusted. And then if the error is that the expense last year was too high, whatever expense it is, that means it follows that income last year was too low. And so we have to adjust up, and vice versa. If the expense was too low, net income was too high, and we have to adjust down. So I think that's about all you need to know for the retained earnings statement.